Hey everybody, it's Andre Bagansky from Decrypt coming to you with another interview, this time with Juan C. Lopez, a managing partner at VanEck. Nice to see you, Juan. How are you doing today?
Doing good, Andre. Thanks for having me.
We've got a little bit of a Florida interview today with both of us located in the South, so plenty of sunshine. Today, really wanted to pick your brain about what's going on in the venture world. Lots of M&A activity going on. It feels like every week we have a big crypto deal that's the talk of the town. Juan, I would love it if you could maybe give a little bit of background about yourself and introduce yourself to people who may not be familiar with you.
Yeah, happy to. And thanks for having me. So I'm Juan. I'm one of the partners at VanEck Ventures. VanEck Ventures is our first venture fund out of VanEck. For those that may not be super familiar with the firm, it was founded in the late 50s and got really its start in the world by pioneering the first gold mutual fund back in the day. So today, VanEck continues to be family owned, and we manage north of 100 billion across global strategies, primarily via ETFs and mutual funds. And we've been incredibly excited about the opportunity in both crypto and privates for some time, which led us to file for the first Bitcoin linked ETF back in 2017. And since then, we launched two strategies: a hedge fund, which is managed by Pranav Kanade, and that's long only primarily token picking, and a venture fund, which we announced late last year and really got off the ground earlier this year. So that's a $40 million vehicle. And our mandate is to back early stage companies building around this next platform shift in fintech, we call it, from pre-seed to Series A. So my partner and I, his name's Wyatt, we were both at Circle before this. We spent the last 3-4 years there building out the corporate venture arm called Circle Ventures. And since then, we invested in roughly about 100 companies building all around the stablecoin stack, from layer ones and layer twos all the way to the payments applications and consumer applications that are distributing this all around the world.
Yes, excited to dig into you, especially about the differences between sort of the infrastructure plays that you're seeing a lot of companies sort of glom towards and consumer applications and sort of the nuances there, especially, looking at it in terms of assessing those investments. I think a great place to start is, what do you think are the most pivotal sort of deals or acquisitions that we've seen so far this year?
Yeah, I mean, it all started last year actually with the Bridge acquisition. I think that just kind of kicked off a series of events to put stablecoins at the center of fintech. We really do think of stablecoins as kind of this 0 to 1 moment for crypto to actually be talked about in really every boardroom in both financial markets and in fintech more broadly. So when the leading platform in payments sets this as a high priority, I think it's understandable to see that happening in the agenda of every boardroom. And when you sort of unpack why, it helps us sort of address this dilemma that's been going on for ages around, who can win the race in payments? Is a vertically integrated platform or is a horizontal platform? And the reality is, in our opinion, it's both. Stablecoins sort of, and crypto generally sort of accelerate the velocity of money, and that helps the pie grow much, much bigger. And there's going to be many winners. So I think it started with the Bridge acquisition, and then that's an interesting contrast with the most recently announced Rail acquisition by Ripple, which has materially different price tags, even though both companies, from our vantage point, were somewhat similar from a traction perspective. At least last year, there's been some material developments that maybe sort of had them differ from each other, but they were both payments companies seeking to bridge the worlds of sort of traditional payments and stablecoins. And
just to jump in here, as far as I understand it, like the acquisitions with those companies, it was really centered on this idea of having on ramps and off ramps between fiat currencies and digital tokens. For readers that might not be familiar with why that's so important, can you talk to me a little bit about why on and off ramps really are such good targets for acquisitions?
Totally. So, I mean, going back to when Bitcoin was first starting to become a popular asset, there was not necessarily a good user experience around how you go about purchasing Bitcoin, selling it, and having that be all within sort of a user experience that looks similar to, let's say, Robinhood, where you deposit your funds, you can trade stocks, and then suddenly your funds remain there, similar to other brokerages. That user experience was not necessarily there, and there was like long settlement times for you to get your funds to hit the bank account of the exchange that you were using. And long story short, stablecoins were introduced initially to sort of bridge that gap, to give users the ability to hold funds in an account, have that settle instantly, and have sort of a homogeneous unit of account that can be transferred across exchanges. Today, that's actually very different. And on and off ramps have been a large driver for some of the new use cases that we hear around stablecoins. We hear things like cross-border remittances or B2B payments that are now, settled instantly. They're 24/7, so on and so forth. And the reason why that's now possible is because on-off-ramp companies initially were the ones that were connecting the legacy payment systems with the sort of blockchain adjacent systems that exchanges pioneered. And today, even though initially we thought of them as just on and off, the typical flow in an on-off ramp company will be, if you, Anjay, want to purchase Bitcoin, you will wire, or you'll send me funds via ACH here in the US, and I will go out and source, as an on-off ramp company, go out and source stablecoin liquidity from the likes of Circle or another stablecoin provider, and give you that stablecoin and monetize off that via transaction fee. And while initially that was driving lots of transaction volumes, it actually lacks in comparison to what you could do with that on-off-ramp infrastructure to do things like cross-border payments and B2B payments. So happy to sort of talk about that a bit further. But that's why, on-off-ramp companies sort of cemented an interesting place in the market. And now they can go from simply calling themselves as on-off ramps to full-fledged payments providers built on this really novel infrastructure, which is a lot sexier.
Yeah, well, I mean, you talk about sexy, right? Technology versus licenses is a thing that comes up for me when I'm looking at these companies. How much of this M&A activity that we're seeing so far this year is companies sort of positioning themselves around licenses, like getting the ability to operate in a certain jurisdiction or something along those lines, versus like the technology itself? Because it feels like activity is more concentrated on the former than the latter.
Yeah, I would agree somewhat. I think the nuance there is that the way we think about licensing, it's really a time to market value, meaning if there's a particular player that wants to enter a particular business, they can do so much faster. They can acquire a business that's gone through all the regulatory hurdles to actually be licensed to operate in that particular business or jurisdiction. And while what we've seen so far may be focused around licensing, I think there's just not a whole lot of lasting value in the technology lens. And I think, to echo your sentiment, value really is today and so far has concentrated around the endpoints, around the customer and consumer endpoints, where you can build meaningful relationships and you can rip and replace the infrastructure, and you can offer all sorts of different products, but really building that consumer trust and that business relationship to be able to cater particular products to them is where most of the value will lie. And so, for us in particular, some of the acquisitions we've seen today may be time to market type, but I think they're largely to reach customers that they otherwise couldn't. And I think that's a little bit of what we've seen with Bridge, with Privy from the likes of Stripe, and I think we can generally give a similar sentiment for the Decrypt acquisition for Coinbase as well.
Yeah, I'm also thinking of Robinhood and WonderFi as being one of those acquisitions that sort of unlocks a new jurisdiction to play in, if you will. Now, you talk about infrastructure, right? The idea of sort of investing in the technology itself, where you come from at VanEck. Where do consumer applications sort of fit into all of this? Because I think if there's one thing that the crypto industry is really good at, it's sort of building infrastructure, but sort of these folding the services, folding that into an actual service that gains popularity. Like, how do you think about that in your role as sort of a managing partner?
To set the stage, I think real consumer endpoints are kind of lacking in crypto. And that's been both a sort of product problem. It's been a product marketing problem as well. Just being able to translate, like, what is the core utility, or what is the sort of solution that we're building here? Why should users care? And I think, we're early and the market's maturing, but I would say they're generally lacking. I mean, we're probably at sort of tens of millions of monthly active users, which is just generally low relative to our more traditional sort of big tech counterparts. The way we think about this is we're a little bit more bearish and just broad scale infrastructure. Think like all the stuff we've heard in recent years, whether it be like ZK, modularities, all that stuff, while useful and while inspiring, and I think unlocks the next set of developers to sort of build more powerful stuff, I think it basically puts the go-to-market and sort of brand building functions in the back seat. So the way we're looking at this is we're much more focused on finding the teams that have the know-how and have the ability and sort of secret sauce to being able to capture attention and be able to serve products in a very user-friendly way to users, and have a material value prop that's going to get them to switch over. Because one thing about this particular landscape is in fintech more broadly is that most of the things that we want users to do, they're kind of already doing in other applications. So whether you want to send money or save money or invest it, or whatever you want to call it, there's probably someone else in a more traditional sense that's sort of serving that product to businesses and consumers. So I think the value prop just has to be that enormous to get them to sort of grip and replace, and stop spending as much time in front of those screens and get them to switch over to some of the things that we're proposing, which today has lacked relative to sort of some of the growth in outside applications in big tech.
That's kind of interesting, Juan, that as a tech investor, you have to be aware of the attention economy no matter what. It's same thing as a journalist, right? Where it's like you got to be aware of like those attention trends.
Totally, totally. I mean, there's many ways we could sort of take this, but generally, I think that explains a bunch of the sort of speculative mania in crypto.
I imagine you get a lot of questions from people that are within the sort of realm of traditional finance when it comes to stablecoins. And I am really curious, like, what is sticking with them and what isn't sticking with them in terms of the way that they think about stablecoins. I think also, like, we can't bring this up without smart contract platforms as well, like Ethereum versus Solana. I think Tom Lee has been out there pretty aggressively saying that, Ethereum, stablecoins exist on Ethereum, therefore Ethereum will benefit. But I'm not sure Wall Street thinks of it that simply, or sort of where they're at in the whole stablecoin story. And I know I'm taking up a lot of oxygen right now, but I remember November 2022 when FTX collapsed, and I'm like talking to my grad school advisor, and I'm like conflicted because I'm like, yeah, I want to stick around. I want to report on this industry a little bit. He was telling me at the time, crypto is not going to exist in 3 months, let alone a year or whatever. But I remember like looking at my bank account and sort of saying to myself, there's a really solid chance that stablecoins just kind of like are like an invisible backbone here by the end of the decade. And I stuck with crypto as a result of it. And it was literally back then like this conviction of like, yeah, stablecoins are just going to become like part of my bank account, and I'm not going to really know or care for that matter, right? But sort of going back to the question, what's sticking when it comes to the stablecoin narrative and what's not?
Yeah, no, that's a great one. I think just to answer the second piece first, what's not sticking, it's been first and foremost this like general purpose aspect of the asset. Like the form factor of the asset and how general purpose it is seems to be the thing that most people are confused about. I think you could listen to some of the Circle earnings call today and some of the questions from analysts. I think it's pretty clear that there's just not a clear understanding of what activity drives certain behaviors, and what volumes, or how you represent certain volumes in whether it be commercial or capital markets activity, or even this more obscure like MEV searcher type stuff that you typically hear of in sort of crypto capital markets. So you get questions such as, hey, stablecoins could potentially be used for payments, but like why should they be used as collateral for a commodities exchange? And I think that begs to sort of question, like, we haven't seen this general form factor in digital form. We only know it as cash, right? Like cash is obviously, you could use that for anything in its physical form. And I think this question of like, can you actually digitize cash and all of its attributes, whether it's like, privacy and confidentiality, to a fully settled payment that you can't necessarily run a chargeback on a cash transaction. Those remain they haven't been seen before. Therefore, I think the street and just investors and market participants generally don't seem to understand that like there's a general purpose instrument that could be used for all these things.
So a lot of people just don't know the fact that like you can't charge back a stablecoin transfer or something along those lines.
More so that because you cannot, it's probably not going to be mainstream. And I think they lack the sort of intuition to say, hey, the fact that it's not possible through the nature of the token itself doesn't mean that you can't build on top of that, and that you can't build applications and middleware that sits in and around the stablecoin ecosystem to actually facilitate all those things, and more importantly, like all the things that we haven't yet came up with because they just haven't been possible just yet. So I think that's largely what's most misunderstood, is the general purpose of one asset and a particular set of rails being used for a capital markets transaction, for an e-commerce transaction, for sending money to your loved ones around the world, or FX. The same rails and the same assets are used as building blocks for all those things. And traditionally, understandably so, like each one of those flows for a traditional sort of market participant occurs and takes place in a very different fashion, right? Like we can map each one of those use cases, and they're cleared differently. They're orchestrated through different businesses and different front ends. They're priced differently. The value chain of each one of those and sort of the supply chain of that payment just operates very differently. And when you look at and compare all that to, hey, what would a world look like when it all runs in a set of open ledgers? There's obviously questions that we haven't yet solved for, but I think it's still, it takes a little bit to grapple with that it can all run on the same infrastructure.
Yeah, I mean, a lot to really chew on there, Juan. I think, I'll just take it in the order of like, what's one of the unresolved issues that you're sort of seeing when it comes to stablecoins? Because the fact that you still think there's more work to be done on that front, I think is super interesting.
I mean, I'll give you two things. One is the ability to redeem stablecoins at par value, and how that determines whether stablecoins can potentially be seen as cash equivalents. It's a huge unlock that I think we are on track to, but still has yet to come. And then the second piece is really privacy and confidentiality, right? Like giving consumers and businesses this right to, have a private financial life. And that honestly kind of, there's trade-offs between that and building on an open sort of permissionless programmable ledger like you would on something like Ethereum or Solana. Those two don't necessarily match, right? Like this right that you have as a consumer to have private finances, and this notion that a developer, to serve you the best application that they could, likely has to have certain properties be extensible to other applications that can verify your collateral or can verify who you are. And therefore, there's some things that need to be solved for there that I think we're sort of on track to, but are still yet to be solved.
I wanted to, just before we get too far away from it, you talked about Circle's earnings call this morning, and I wanted to get like what was like one of your big takeaways from the earnings call. It sort of transitions well into my next question that I got.
Yeah, I mean, the biggest takeaway is just how costly the IPO was, right? Like 500 million or so in IPO associated fees. It's pretty wild. It's pretty wild. I mean, relative to other IPOs, of course, you could comp it, but I think it's just pretty eye-opening to see like how much it costs to take a company public and to make, ownership and economics and control accessible to a wider set of participants. When in reality, when you really boil this down, it's just a transfer from one ledger to the other. We're just transferring who owns what from one ledger, which is private, to another ledger, which is open to more public investors. There's obviously a lot that goes in between that, and a lot of sort of game theory and some of the work that the investment bankers do to make sure that they get the best bang for their buck, and that they prioritize certain investors that can allocate capital and ultimately get that as a response in the price action. But at its core, it's really just a transfer from one ledger to the other.
You're bridging. It's a $500 million bridge. Yeah. I mean, that's pretty shocking is a great way to put it. I mean, like, the reason why I wanted to ask, I'm glad you brought it up, is because like often like I ask this question, is it narratives informing price or price informing narratives, right? And I think that we knew stablecoins were cool. We knew stablecoins were coming into a moment of their own on Wall Street. But I do feel like the success of Circle's IPO, I mean, crank that dial up to 11, right? Like, where do you sort of fall on the stablecoin hype, where it's like, Circle's cooled off a little bit, it's not it's not the shiny new toy on Wall Street at this point, but it does still feel like people are talking about stablecoins. And I do feel like with Ethereum's recent rise, like it's sort of solidified that a little bit, I think, in terms of the investing public's mind.
I mean, it goes to the core of this premise of attention capital markets, right? Which is, I'm not sure if narrative or price are, come before one or the other today. It's just clear we're sort of in this vicious cycle where a strong narrative and a lot of attention, initially perhaps around Bitcoin, more recently around AI, and now stablecoins, just really drive all the capital and all the interest from outside investors, regardless if the principles and the fundamentals are there. So I think of this as kind of an inverse pyramid where at the very top, you have most of the investor capital really seeking sort of speculative behavior around the stock, while at the bottom you have others that are kind of more fundamentally driven.
Well, you talk about AI, right? I'm surprised you didn't tell me that Wall Street analysts are just clamoring to know how AI agents are going to end up using stablecoins in order for the next generation of commerce. I'm not completely sold on that one just yet, but I know it's super exciting. I'm going to shift direction on you real quick here.
Yeah.
The Wyoming stable token. Have you been following it at all?
A little bit.
Yeah.
Yeah. I think there's a couple a recent founder that we spoke to that's actually building something with it. So that was kind of shocking to hear. But yeah.
Well, it was shocking for me to really dig into the project in the sense that its debut is expected later this month. And one of the things that they're sort of talking about is this idea that they don't fit the statutory definition of an issuer under the Genius Act. And as a result of that, their stablecoin might be yield bearing. Like we might have yield bearing stablecoin that is in the US, but because of that distinction between sort of it being a public good versus it being like a private company's product, like they're towing the line there in a very interesting way. And I'll even take it a step further. Conservatives, Marjorie Taylor Greene among them, have sort of come out and criticized the Genius Act, saying it creates like this apparatus for state control, because there's sort of caveats in there that, you got to have the freeze function. You got to help us be able to seize funds from criminals. And the Wyoming stable token, some of the people involved in that project really came to me and said, we've gotten pushback, people calling us a CBDC, but at the same time, like because of our relationship between state and federal government, like we're going to scrutinize those sort of requests much more than another company might. And we could even push back against them. So I think there's a really sort of, I don't think it's fully, like once the token launches and they start to move this, I'm sure we'll get this sort of coming to the forefront of the news cycle. But I'm just curious about like what you make of that there. Like the fact that we could have like these state issued stable coins.
Yeah. I mean, I think of it similarly as maybe we call them yield coins now, which is now not to generalize everything as a stable coin, but the Athenas of the world. And the USDSs of the world by the maker team. And while the beautiful thing out of all of this is like we don't have to call everything a stable coin, yet that doesn't necessarily mean that it doesn't have utility, won't have product market fit. Ultimately, they all sort of benefit the dollar system, whether directly or indirectly, by being denominated in dollars. And so I think we're going to see, this is just the beginning, but we'll see an explosion of dollar-denominated assets that use this form factor, maybe some of the marketing and hype of stablecoins, to sell something else, right? In the eyes of the Athenas of the world, this sort of really sizable now hedge fund and a strategy that can sort of meet investors depending on and give them sizable returns, regardless of bull or bear market. And in the eyes of this stablecoin that you talk about, be able to essentially finance like the state's development through bond issuance, and be able to back the stablecoin through that level of issuance, and potentially attract more commercial activity down to the state. So everybody will have different interests. Ultimately, like we now have regulation for a type of stablecoin through the Genius Act, but not everybody will follow it. And I think we'll have a sort of a still like a pretty strong gray area of assets that will be successful because they don't necessarily meet that mark, and because they have like different needs and demands from their customers.
Juan, I really appreciate you taking time out of your day to speak with me. I think this has been a really interesting conversation, just from the perspective of like you as an individual who bridges the world of suits and hoodies. being able to sort of speak to those crypto native sort of ideas, but also being able to sort of frame it in the parlance of traditional finance and really being able to understand that mentality, I think is really, really, really great. Anything that I didn't sort of ask you about that you feel like is a necessary part of the stablecoin conversation, or just, what your sort of general thoughts are in terms of what you're seeing among projects that are cool?
I mean, I guess the big thing is that now stablecoins are sort of front and center. They're super consensus. I think if a particular payments related company is not paying attention and making sure that they're well positioned for this big platform shift, like I think they're being left behind. And I think the exciting piece is to ask ourselves, like, what happens next? Like, once all these assets, whether it's the Wyoming stablecoin or the Athenas of the world, or more the regulated stablecoins like USDC, are widely distributed and reach people's wallets, because inevitably they will. They're just a better form factor of money that has a real sort of economic incentive to do so. It's cheaper and it gives more rewards down to their users. What happens next? And I think what happens next is we see an explosion in the asset management business, where you can actually see where stablecoins sit and who holds them, and therefore what products are potentially successful at raising some of that capital in a more direct and programmable way. So I think you'll see an explosion in assets that are, whether it's reinsurance or whether it's real estate or whether it's, all these different asset classes that are fighting to attract capital, and they do so in a very clunky and fragmented way. They'll be able to do so in a much more streamlined way, and in a way that sort of taps directly into that stablecoin liquidity to meet the capital demands of all these different industries. So that's that's what's really interesting to us and what we're paying close attention to.
Well, thank you. I appreciate it, Juan. That's going to conclude it from us today at Decrypt. Make sure you check us out for all your crypto news. I'm Andre Bagansky. This was Juan Lopez, and thank you again.